Hi, my name is Jade, co-founder of Legendary Real Estate Services, and with the real estate market shifting not only nationally but here locally in the Walworth County, Geneva Lakes area, it's creating uncertainty. So what I want to do is give you a by the numbers breakdown to help you understand what's really going on in the real estate market. That way you can make the best financial and investment decisions for you, yourself, and your investment portfolio. So let's dive into just a few topics that we are going to cover. First, there's a lot of talk about recession. There may be one, but it's not going to be nearly as bad as the 2008 housing crisis, the recession that was caused after that. Why? I'll show you that in this video. We're also going to look at the fundamentals in our local market that is causing the softening in our market and what is going to have to happen to reignite demand, reignite the market in our local area. All right, so let's dive in. This is a screenshot of some of the stats from the Metro Multiple Listing Service that aggregates data of homes on the market and homes sold within the county or within the area that I selected, which is Walworth County. So the first one we're going to look at is the absorption rate. This is actually a misnomer. It's called actually a months of inventory. So what this means in a nutshell, if no new homes came on the market today and indefinitely, how long would it take for the current market to absorb the available inventory? And right now we're sitting at 2.03 months of inventory. Now, what you need to understand about this graph is it depicts supply and demand, or in other words, availability of homes. If we are less than 4 months of inventory, we are in a seller's market, and we've been in this seller's market for at least since the start of the pandemic, and we've oscillated between that 1.5 to 2.5 months of inventory. So as you can see in Walworth County, the availability of homes is low. Supply is still low. So mathematically, we are still in a seller's market. What this graph also tells us is that if we do go into a recession, it's not going to be anything like the housing crisis caused in 2008. The reason being is because in 2008, we were in the hypersupply real estate cycle, meaning there was an abundance of homes. We had more than 6 months of inventory. This number was way up. Anywhere between 4 and 6 months of inventory is a balanced market. Anything above 6 months of inventory, that is a buyer's market. And that's what we had in 2008 and past when we had that housing crisis, because there was an overabundance of homes available. What happens when there's a lot of supply? Demands go down and housing prices as well. Our low inventory is fundamentally keeping prices where they're at right now. So this is good news from a price standpoint for the housing market. Let's take a look at this particular graph. It's sold days on market. What's interesting about this graph is that it depicts the state and health of our demand. Since the pandemic, this has been oscillating around 40-ish days on market, going up, going down, oscillating around that 40 days on market time frame. And then all of a sudden, it started really picking up. What happened in December of last year is it nearly doubled. We didn't see days on market go this high for almost 2 years, maybe plus. What you have to take into account is normal seasonality. So right now it's the winter months, holiday months, and especially we had that cold couple of weeks, so no one's really gonna go and look at homes, have people come into their home, probably don't even wanna get out and show their home in that time frame. So that really plays into a factor. However, keep in mind, again, we haven't seen this high of days on market in a very long time. It really starts corresponding as interest rates went higher and higher. It could also be a reflection of house price affordability, in the sense of the people who are in the market, they could afford a lot more last year than they could this year because of that interest rates. But also keep in mind, we saw a huge price appreciation. So not only are homes less affordable, but even more so it's exaggerated by those high interest rates. So those buyers, they can't afford nearly as much as they could 2 years ago. So that's what's going to dampen demand in this market. And that's what we can see in some of these graphs. Now let's take a look at prices. So if we look at this graph, looking at January of 22, the sold median sale price is $304,000. $300,000. Now, fast forward to December, just last month, that median price has jumped to $346,000. That's a $40,000 increase in median sale prices of homes sold. That's a huge jump. Now, if you add on double interest rates, that's really going to again affect the purchasing power of buyers. We're going to take a look at one more graph. This is what's called the sales to original price ratio. Basically, in a nutshell, it shows the ratio of where homes sold in relationship to what they originally listed at. So say, for example, you have a home, $100,000, you sold it for more than that, your sale to original list price ratio is going to be above 100%. Conversely, if you sell it for less than what you listed it for, it's going to be below 100%. And this is going to be the average of the homes sold last year. It was pretty strong earlier this year. It was pretty strong in 2021 and in 2020. And this number has really not gone below 98-ish% in the past couple of years because, as you know, homes were just flying off the market for above asking price. It was very crazy 2020, 2021. However, as you can see, once it reached its peak this year, we see a slow decline, which corresponds to about the same time as interest rates. As interest rates hiked up, the sale to original list price ratio really started coming down, coming more under control. Why did it blip this low when it hasn't been this low in a while? Well, part of it is that seasonality. It's curious to look that the days on market accelerated in December and it corresponds to the sales to original list price ratio. Is there a connection? Possibly, probably, maybe, maybe not. It's something to look and keep an eye out, these two numbers, really in this next month when they come out with updates of this. Part of it too could be psychological as far as seller expectations. So a lot of sellers that sat on the sidelines, or maybe they decided now to sell their homes because of life changes, they saw their family, friends, and neighbors' home sell for such high amounts and their expectations may be just a little too high. And so what's happening is they're wanting to list their homes above the fair market value. If we don't have a balanced market, but what we do have is sort of an artificial balance created by the supply and waning demand. So right now, buyers have a lot more negotiating power because there's so little of them and because they can afford a lot less. So that's what we're seeing with the sales to original list price ratio. It is a combination of interest rates, and it's likely also has to do with the mindset of sellers that want to sell their home now and want higher than fair market value asking price. Okay, so now what has to happen to reignite the market, reignite demand, and create a more balanced market? Well, the first thing is going to be affordability, and that's going to come in many forms. That could be higher wages, which is beyond the scope of this video, or lower prices. So lower prices could happen in a number of ways. Lower prices could happen because there is a moderate but healthy market correction. So not a crash, but a correction, a return to the mean or normal trend of housing prices. That's one way. Another way is new supply comes on the market, which is going to affect inventory. So if there's going to be more inventory available, more supply, then that's going to create a bit more of a balanced market. Or maybe even the construction of more affordable homes that are more around the median market price area of $250,000, $300,000, $350,000. So that's what can happen from an affordability standpoint. Another way to reignite demand is going to be the obvious lowering of interest rates. We're never going to see those historic lows again, but if they come down to make it more affordable, more buyers will come back into the market. First-time home buyers or repeat home buyers who want to downsize, upsize, or just have life changes going on. Sellers, like I mentioned before, they're going to need to adjust their expectations and price their homes fairly. That's what's going to really help to balance out the sales to original list ratio. Lenders, they're going to have to explore more creative yet healthy strategies for buyers so that they can not get around the high interest rates, but make it more palatable to them. So for example, a home buyer wants to buy a home for a long term, maybe consider purchasing points if it makes sense for their financial profile. I'm not a lending expert, but that is just one particular strategy that lenders are going to have to be more proactive about to help these first-time home buyers or investors make more savvier decisions from a lending and interest rate standpoint. I hope you learned a lot. I had a lot of fun doing this video. Hope you had fun watching it. If you would like to get these videos on a regular basis, they're going to be done monthly. Definitely subscribe using the link below to our newsletter. If you want more information, so I did created a couple articles that really go into the fundamentals of why this isn't, if there is a recession, there isn't going to be a hard crash like it was last time. If you're curious to why, click the link below as well, and we'll see you next month. Thanks. Bye now.